Alrighty, Corey, if you want to go ahead and get this party started, I think we can go ahead and get it in there, and anyone that filters in will just be filtering in a little bit later on.
All right, yep, I'm perfectly ready, Alex. Everyone, thank you very much for signing in with us today, whether you're watching this at the evening time as we're doing it live or at your own convenience. Alex and I are here from Advanta IRA to bring you this webinar on solo 401ks, how to save thousands on your taxes while adding thousands to your retirement account. Again, my name is Corey Daharsh. I'm here with my colleague, Alex Perny. We've both been with Advanta for at least 5 years. Alex has been here much longer than I have, and we've both received our designation of Certified IRA Service Professional. So that's really just to say that we're both pretty much experts in what you can and cannot do with US-based retirement accounts. So we'll be here to answer all of your questions, and again, specifically go over the Solo K plan that we offer at Advanta. Alex, thank you very much for doing this presentation with me today. I know that I'll be covering most of the front half of things, and you'll take over about the middle and cover the second half. So thanks for joining us today, and anything you would like to say at the top?
No, absolutely. Just want to remind people to make sure that you type in any questions that you have, even if it may not necessarily seem super pertinent to the slide that is maybe being covered at that moment. Please do type it in because it might help us on a tangent that could certainly help benefit other people. And obviously, you have us live on this call to get any questions that you have answered, especially with the end of year coming up. While they are not as important of deadlines as they have been in years past, definitely some things that you might want to get in place and get started before too much longer, so that way you can take advantage of some of the great tax savings that we're going to go over for solo 401ks for you individuals out there that do have self-employed businesses. So happy to be on here with you today, Corey, and I'll let you take over the first half and I'll jump in on the second.
Perfect. And one other thing I'd like to just point out, we did drop a handout in the handout section of your GoToWebinar tab, so you can download the PDF of our slide deck for today. Also, if you'd like to reach out to either Alex or I after the webinar, this slide has all of our contact info. We'd be happy to send you that slide deck later, and or feel free to reach us on our YouTube channel. You can find other webinars of similar content there, but I'll go ahead and get moving forward. So Advanta IRA is a self-directed IRA administrator custodian. We've been around for about 20 years now, and we do have a mix of certified experts in these fields, whether it's a CISP like Alex and I both have our designation, or a SDIP. We are experts in this specific industry of alternative asset investing. Any money that clients of ours have in their accounts undirected, meaning not specifically in an active investment, are insured up to FDIC limits. We do have a client base of about 8,000 active clients with just over 2 billion in assets under management. And one of the things, aside from these educational type webinars and content we put out, that we try to do to stand aside from our competition in this space is we provide a dedicated client account manager to each client that we have, so that they don't have to reach out to Advanta and speak with a different person each time. They have a dedicated person that they get familiar with, then that helps them with any questions they have, concerns they have, investments they're trying to process. It's really a concierge style account manager. I served in that role for a number of years leading up to the beginning of this year, and it's a really great way to get one-on-one service with your self-direct account. Before we move too far forward into our content today, I do want to disclose that Advanta, its employees, do not provide any specific investment advice or endorse any specific products or offerings. All information and material that you see from Advanta is for educational purposes only, and we do always encourage you to consult your own CPAs, attorneys, accountants, financial advisors for proper due diligence before making any investment or proceeding with any investment strategy. If you do not have attorneys, accountants, or CPAs that are well versed in self-directed investing, we do have some we could refer you to. So just again, please feel free to reach out to Alex or I if there's anything of that nature we can assist you with. So the key takeaway points that I'd like everyone to make sure they have from today's webinar is that these solo 401k accounts or employer retirement accounts have much larger contribution limits than your typical IRAs, whether it be a Roth or a traditional IRA. There are other types of IRAs, SEPs and simples, that have a little bit higher contribution limits than Roth and traditionals. We'll cover those very briefly later on, but it is important to note that these 401k accounts have a significantly higher limit. So on an annual basis, you can get much more money into an account and even have that money be tax-free if you do some Roth processing of those funds. The checkbook control strategy can be utilized through a self-direct 401k account. So it's a way, if you're not familiar, that you can have much more direct access to your retirement funds to make those investments that you're trying to make in a very quick manner, as opposed to processing investments by way of the custodian and administrator directly. And the third key takeaway point is the ability to invest into real estate through a self-direct or solo 401k plan in a tax-free capacity. Now, when we're talking about real estate investing, and that involves finance leverage, there's a certain type of tax called UBIT or UDFI that may apply in most cases, but with these solo K plans, it's usually something that does not actually apply or is not applicable given the structure and setup of that investment strategy. I believe we'll be covering that a little bit more later on in the webinar, but again, if that's something that you're specifically interested in, please feel free to reach out to Alex or I, and we'll be very happy to help you in a direct capacity with those questions. So if you're not familiar with an employer-sponsored plan, an employer-sponsored plan is a retirement account that you would set up typically as a sole proprietor. In our case, as a sole proprietor, there are larger plans that do cover if you have employees. We are just not specifically set up at this time to cover those types of plans. And this plan can be a 401k, a SEP, a simple IRA account, which I also referenced earlier. And typically, these types of accounts are set up so that you can start to build towards financial independence with your retirement planning. The 401k in itself is an account that was established in 1974 with the IRA accounts as part of the ERISA Act that was passed again in 1974. So one thing that you may be thinking is, how do I get money into one of these types of accounts? And the first option is to make a custodian to custodian transfer. Typically, transfers are done between like accounts, meaning if you've got an IRA with one custodian and you want to transfer to a self-direct custodian of that same type of IRA, it's very simple. You just fill out a form, that form gets processed between those two custodians, and that money typically moves with no taxable reporting, just documentation going from the first custodian to the receiving party after that process has been taken. The other option for moving money in a self-direct capacity is to do a direct rollover, or an indirect rollover for that matter. But a rollover occurs when you're moving from one type of plan into another type of plan that is still a tax disregarded entity or a tax sheltered account. So an example would be if you have an old 401k plan, 403b, 457 or TSP pension plan that you'd like to roll over to a self-direct account. You essentially initiate a distribution of that plan and then roll those funds into the new account. There is tax reporting in this case scenario, but as long as you're moving the full amount and that full amount's received at the receiving end, those tax reporting will wash and there will be no taxable event occurring. That will all be documented on Form 1099-R for the distribution side of things on the plan you're rolling out of, and Form 5498 on the receiving side for the plan you're rolling into. So with self-direction, whether it's an IRA or a 401k like we're specifically covering today, you have plenty of investment options. I've got a lot of different bubbles here on the screen and some caveats down at the bottom for additional investment strategies, but it's really easy to inform you what the IRS does not allow you to invest into to make it easier. And that is life insurance policies, or things that the IRS rather would consider a hard to value asset, or anything subjective in value. Examples of that would be antiques, fine wine, even antique vehicles. Things that have a subjective value, or life insurance policies, are really the only asset classes that are restricted by the IRS. And anything else, as you see here, for the most part can be invested into through a self-directed strategy. So there are a few key components of employer-sponsored plans. First is the sponsoring business. for you to have an employer plan, you would need to have some sort of business entity established that can be the sponsor of that 401k. The next component is the participants and employees. For Advanta's 401k plan, usually there are no employees in this case, so it would just be yourself as the sole proprietor, maybe potentially a spouse or a business partner. And again, there are larger plans that cover more employees, and those types of plans we just are not set up at this time. We can refer you to other providers for those larger plans, so feel free to reach out to Alex or I if you're not sure if your use case would fit for a solo plan or a larger 401k plan. And the third component of an employer plan is the contributions that can be made. As I referenced earlier, the contributions are much higher than a traditional or Roth IRA and can include employee deferrals from your earned income, an employer deferral, and then a post-tax employee contribution as well. So specifically today, we're going to go into the benefits of the solo 401k plan. As I've referenced multiple times, the higher funding limit is one of the biggest and key benefits of a self-direct solo 401k. You are able to defer a larger amount of your earned income. As I just referenced on the previous slide, there's employer contributions, employee contributions, and then an additional employee after tax non-Roth contribution component that you can make. You're able to roll over funds from other retirement plans into a solo K. So if you've got other accounts, like I mentioned earlier, maybe a 401k or a 403b with the previous employer, those types of monies can be moved into this solo K plan so that you can benefit everything in one larger capacity instead of having, an account here, an account there that are all benefiting for you differently. It's just a way to consolidate and get all your funds together for your investment strategies. You're able to access tax-free loans from a solo K plan. There's an investment strategy called a qualified participant loan that you could take advantage of, where you're basically borrowing against your 401k, paying yourself a market interest rate for that money and making those payments back into the account. The rules are that you have to make the payments back within a total of 5 years. There's some basic stipulations, but it's a really good tool if you're looking to get a hold of some of that money in a tax-free capacity to loan to yourself. And again, as I also referenced a few moments ago, you can avoid UBIT tax on leveraged real estate investments by using a solo K plan as opposed to an IRA, whether it's a Roth or traditional. The cost-effective administration of these plans is another key benefit. As a solo K holder, you're basically just establishing an account with a custodian like us and then managing that account either directly through Advanta or in your own capacity via our do your own plan model. Later on, Alex is going to go over some of the different models that we have for solo K accounts and different ways you can actually proceed depending on your level of involvement and interest in the solo K plan options. And the final benefit here on this page that ties us into the next slide is the Roth component of a 401k account. So again, when we're talking about 401k accounts, you do have the ability to make Roth deferrals or Roth contributions so that you're growing that money in a tax-free capacity for your future. As the business owner, it's key to remember that you're holding two hats here in this solo K scenario. You're holding the employer and the employee position as far as the sponsoring of your 401k account. When you make your employee contributions, you can make contributions up to $19,500, and that can be made as a Roth contribution. The employee contributions really don't have to be made fully Roth or fully traditional. You can do any split up to that annual limit that you desire. The annual contribution limit for employees is much higher, again, for a Roth IRA, for the 401k than a Roth IRA. The Roth IRA is either $6,000 or $7,000 if you're over age 50, and we'll get into the actual exact dollar amount of your total 401k contribution in the next few slides I'll be covering. And it's key to note that the employer contributions are always pre-tax, but if your plan allows, which Advanta's plan could allow on your application, you indicate it, for those funds to be converted to Roth after the contribution has been made. So as I just referenced, I just wanted to cover the actual plan contribution limits for 2021 across various retirement account options. So the traditional and Roth IRA, as I just mentioned, is currently at $6,000 annual contribution limit with a $1,000 catch-up if you're over age 50. The SEP IRA, which I referenced earlier, very briefly, has a limit up to $57,000 or equivalent of 25% of your compensation. The simple IRA is currently a little bit lower, but higher still than the IRA account contribution limits. And then the 401k plan, you have the $19,500 limit plus a $6,500 catch up if you're over age 50. And that is the limit for the salary deferral as an employee. You add in the additional potential 25% employer match, which would get you up to 57 or 63,000 if you're maxing out everything for a 401k contribution. I'll dive into that a little bit more in depth in the next slide, but I also just wanted to briefly reference that you can set up an ESA, an education savings account for children that has a $2,000 contribution limit annually, or a health savings account, whether it be for yourself as an individual or to cover your entire family, with those limits outlined there at $3,550 plus the 1,000 catch-up, or 7,100 total. So for a 401k contribution, as I mentioned on the last slide, I was going to break this down more thoroughly. So your full contribution that can be 57,000 or 63,500 if you're over age 50 comes from a combination of these three different buckets. You've got your employee contribution, whether you do that as Roth, traditional, or any split of both, is 19,500 plus a $6,000 catch-up. If you're over age 50, you have your employer contribution, which can be made to 20 to 25% of your earned income. And then as an employee, you can also make an additional after-tax non-Roth contribution that would max out your contribution limit at 57,000 if you're under age 50, or 63,500 if you max out each of these three buckets to a total amount over age 50 of 63,500. So an example of a 401k contribution, I've got an employee here, John, who is a sole proprietor, so employee and employer, and he's made $100,000 this year. When John makes his contributions, he's going to make his employee contribution at 19,500, assuming he's under age 50, and that's his max. He's going to have an employer contribution of $20,000. That's the compensation match. And then he also, out of pocket after tax, is going to make a contribution of $17,500. Again, this is not a Roth contribution, but it does have to be after tax money, thus creating a total contribution for 2021 of $57,000 into John's 401k plan.
All right, everyone, I'm going to take it over from here. I've been answering some people's questions as they have come through. We did kind of have some good ones, a little bit of a bigger one. So as opposed to typing this in, this might be a good one to actually read out. So I'm just expanding this window. Okay, so the question that was posed is that if I have a SEP IRA with my sole proprietorship and also own a separate business, which is filed as a sub S corp, which has no employees and no other shareholders, can I also have a 401k set up for that S corp? If so, do you have to have a salaried employee in that S corp? Can I make full contributions to the SEP IRA and solo 401k? So essentially what this individual is asking is that can you have multiple retirement plans for different businesses? The answer is not kind of as straightforward as a yes or no. So with regard to that, if you're covered under a SEP plan for one business, and then you also have another entity that you're filing as a sub S, you couldn't necessarily, in that context, establish and make full contributions to both of them. You're gonna fall under what are called controlled and affiliated service group rules, meaning that if you have a vested equitable interest or substantial vested equitable interest in a particular business, you have to treat all of those businesses as being able to participate in a particular retirement plan. Now, you could certainly have multiple different plans for those different types of those different entities, but your ability to max out your contributions is going to be affected. Now, the big issue with having a SEP and a solo 401k is that your contribution calculations for a SEP IRA are going to be based solely on compensation. So essentially, you're going to wipe out your ability to do your salary deferral if you're also maxing out a SEP IRA contribution under the controlled or affiliated service group rules. So in the context of that question, it definitely gets into a lot more complex things. What I would recommend to you is maybe give myself or Corey a call and we can kind of dig really into the nuts and bolts of what you're doing, what might be the best fit for you, because there are some slightly more complex Department of Labor issues that you have to follow and abide by when it comes to having plans for multiple different businesses. It can be done, but it's not as simple as just kind of a yes or no with that one. Pat had asked a question earlier on in the presentation regarding some stuff and provided some additional context. If I have a lump sum retirement severance coming from a nonprofit, can I have can I place that money into a plan like this? Well, it really is going to depend on how that severance is being paid out. If you're working for a nonprofit, and let's say part of your severance was some type of 403B plan or 401A plan, yeah, those types of plans, if that's included in a severance package, if you're getting some type of lump sum or annuitized payout into that plan, you can put those into an employer-sponsored plan, such as a solo 401k. But typically, if you're going to just be getting, let's say, just a check ripped to you for severance from any type of business, you couldn't necessarily utilize that as a contribution to a retirement plan. Although you do have the ability to say, hey, I'm going to take a portion of my compensation in a given year and put it into a 401k plan with that first part of the contribution that Corey mentioned. The problem with that is that the income has to be derivative of that business activity. So if you're a sole proprietor and let's say selling widgets on eBay, or you're managing property or whatever it happens to be, if you had $200,000 that came in from, let's say, a severance package or other business activities, and you only had, let's say, $20,000 that came in from that eBay or that eBay business or the property management business, you could only use that $20,000 of attributable business income for calculating any type of contributions that you'd be making to that plan. So again, some of these questions are certainly great, but when it comes to 401k plans, the answers aren't always kind of a yes or no. And the last question, I'll just kind of wipe this one out. And then again, any other questions, make sure you type those in. We got plenty of time to answer these. I didn't know a sole proprietor can give themselves a salary. And if you do give yourself a salary, do you still have to pay self-employed income tax also? So that is kind of a good thing to bring up, is that when it comes to a solo 401k, you have the two different buckets that you're adding money into that plan. Now, the first $19,500 or the additional $6,000 kicker, if you're over the age of 50 and a half, yes, you do have to pay that out as compensation to yourself personally, meaning that it would potentially be subject to self-employed income tax. Now, the nice part about it is that when you look at the broader scope of the contribution limits, and it doesn't necessarily apply to the slide right here, but the other portion, which is the 25% of what is, in most technical sense, is your net operating income, that other 25% doesn't necessarily have to be exposed to self-employed income tax, because depending on how you file your taxes, and again, this would definitely be a better question suited towards a CPA or someone saying, hey, instead of maybe doing this as a sole proprietor, should I do this as an S corp? Should I do this as an LLC being taxed as a partnership or some type of pass-through, in order to be able to try to shelter some of those funds from being exposed to the self-employment tax while still being able to make contributions to the plan and potentially either make those as a pre or post-tax contribution basis. So I know that's kind of a lot of information to digest, just with kind of a shooting from the hip of answering these questions, but that's kind of as best I can do in the limited scope of this. But if anyone would like any additional context to the answers to those questions, feel free to fire away. I'm a big fan of these plans. I like to get into the weeds and the nuts and bolts with these things. So a really cool aspect of solo 401k plans. Now, it's important to kind of understand before I really dig into this slide is how those contributions are made. Remember, you have your first $19,500 of contribution that you can take just out of your compensation that you pay yourself. And then the other portion is the 25% of the net operating income of the business activity that you're performing. Now, again, NOI, people think, well, I'm just paying this all to myself as salary, or, I don't have separate operating accounts. Just think about it as a whole number. But in the context of this, depending on how you are actually looking to contribute to the plan, you might be able to get more than just the initial 19.5 or the 25.5 as Roth contributions to the plan. You are able to make up the difference of whatever the employer portion of it is into that plan as after-tax contributions. So if you only had, let's say, $20,000 of net operating income in a given year, but you paid out more in salary for some particular reason, you would then be able to make up the difference after tax of the additional $15,500 $17,500 into that plan after tax, personally from the compensation you paid yourself as well. People like to call it the mega Roth contribution. Again, it does allow you to put significantly more Roth contributions into a plan because the business contribution, so that portion of the NOI, that 25%, is always made pre-tax. So if you want to make additional post-tax and maybe not necessarily do an in-plan Roth conversion, or the metrics of how much money you are claiming as, let's say that net operating income versus the compensation paid to yourself doesn't work out, there are ways to kind of play around with some of these rules to allow you to have, to be able to take advantage of some of those total contribution limits and also make significantly higher amounts of Roth contributions to that. An important thing to remember is that a Roth contribution is anything that you're making to this plan after tax. So anything that you're not taking a deduction for on your personal income tax return is going to be considered Roth basis for this plan. So it grows completely tax exempt. Now, if it is not a Roth contribution, you're going to have to track those contributions separately. Now, again, this does add a touch of complexity to the plan, but understand that these plans don't necessarily have to be one size fits all. And if you want to do some pre-tax and some post-tax, you can absolutely do that. Your calculations are going to be based on annual limits. So that is compensation or revenues generated in a certain given year. Now, you do have the ability to wait for a portion of your contributions up until your filing date plus extensions, but any salary or compensation deferrals need to be done by the best practice of the last pay period of the given year in which you are making that contribution for. You must have the amount in earned income in order to make those maximum contributions, kind of going back to what I said of saying, hey, just because you might have a large tranche of cash that you would be able to otherwise make the contributions with, you have to look at where that derivative income comes from. It has to be coming from the business activity that the plan is attached to. So you can certainly be covered by multiple employer plans. You can have multiple jobs, but when it comes to making these contributions, understand that you really have to look at what is being earned by the particular business in order to be able to maximize your contribution into this type of tax shelter. And again, that's something that is going to be best answered by someone like a CPA or a tax advisor, someone that knows your personal taxable situation or your business tax situation as well are going to be the best people suited to answer those types of questions. See, we got some questions popping up. Before I get into one of the other kind of cool aspects of solo 401ks with participant loans, let's get some of these knocked out. Can a partner in a partnership set up their own solo 401k, or does it have to be a company plan you contribute to? So good question. So you have an owner-operated business and you want to set up a solo 401k. If you want to set that up, the other partners of the business are not compelled to participate in it. So they're not necessarily saying, hey, if you set up the solo 401k, everyone has to participate. But what you really got to watch out for in that situation is that the other portion of the contribution, so that net operating income contribution, that 25% of your NOI, has to be equally split amongst the participants of that plan. So if, let's say, you had calculated the contributions and you were going to kick in, you had $100,000 in net operating income, and you want to contribute that to your solo 401k plan, and then all of a sudden the other business partner wants to open a solo 401k and participate as well, well, they are legally obligated to have received a portion of that plan contribution made by the business. So if it was $20,000 that was contributed to just your solo 401k, and then your business partner decides to open up, a account within that plan, they would then be in turn have a right to 10,000 of that contribution that was made to the plan. And that does go back retroactively to a point. So you need to make sure that if you have business partners and maybe they don't want to participate right now, that you really do have a very candid conversation with them about it, because it can definitely get to be a little bit messy, especially if you're invested in something that's highly illiquid. Let's say you purchased a piece of real estate utilizing a portion of that employer contribution aspect. How do you bifurcate that up at that point if you have someone else participating in that plan that was due a portion of that contribution? So again, this kind of stuff definitely lends itself to being a touch more complicated, but that's a pretty good summation of that question. All right, let's see. And last one before I kind of move on through this, just check the time. We're doing good. Let's see, I took a CARES Act distribution from a previous employer's 401A. I understand that you can repay the distribution within 3 years to avoid tax consequence. Do I have to repay that original retirement plan, or can this be repaid to a solo 401k? So great question. To kind of truncate that a little bit, what this individual is asking is saying, if they took a CARES Act distribution, which expired at the end of 2020, or sorry, at the end of 2020, and they are saying, hey, I am going to elect to repay that either in the following year or by the end of the 3-year period, do I have to repay that to that plan? Well, it's going to depend a little bit on how you took the distribution. If that was a participant loan that you took, which was augmented under this slide, which was 100 grand under the CARES Act, if you took an additional loan, then that would have to be repaid directly back to that plan. If you took a distribution out of that plan, that can be repaid back into the same tax qualified type of plan that you took it out of. So if it took it out of a Roth IRA, it can be paid back to a Roth IRA. If you took it out of a traditional 401k, can be repaid back into a traditional IRA. You just need to make sure you're double checking with your tax preparer to make sure that you're dumping that money back into the same type of tax qualified plan, so you don't run afoul of any like double taxation or anything like that. But yeah, that kind of answers that aspect of it. Now, a cool aspect of solo 401ks is that they do allow for access to your money before you are retired. This is what's called a participant loan, meaning that if you want to take a loan out of the 401k, you can take up to $50,000 or half of your vested balance from that plan. Back in 2020, under provisions of the CARES Act, which was the large piece of COVID relief legislation that was passed in May of 2020, you could take up to $100,000 as a participant loan from that plan. Now, these must be paid back within 5 years, and the interest rates that can be charged on these are a point above or below prime at whatever point that is. Now, if you fail to repay this loan, it is considered taxable to you in whatever amount of outstanding principal there still is. And also, with a participant loan, if you do terminate employment, that loan would have to be paid back before you can do an outgoing rollover of those funds. So while it may seem attractive, I always encourage people, before you do a participant loan, look long and hard to see if it actually is the best option for you, because it can cause some very constricting situations a little bit later on down the road for you. Do you want to choose a qualified plan, an IRA, or both? So you can certainly have an IRA, you can have a traditional and a Roth and a solo 401k and a Roth solo 401k. you can contribute to all these types of plans so long as you have enough earned income to qualify your contribution. So you can make a max out Roth contribution to your Roth IRA, and then you can also make a max Roth contribution to a solo 401k, but you have to make sure that you have enough earned income to quantify that contribution, meaning that if you only have $30,000 of earned income, you may not necessarily be able to make that full contribution limit. If you're over the age of 50, you might have to adjust that down. And if the $30,000, let's say, is constituent of not all earned income, and some of it, let's say, is passive income like royalties or interest payments, that may not necessarily qualify in order to be able to make those contributions. In some cases, you may not be able to contribute to the Roth IRA directly if you have too much earned income shown on a given year for your modified adjusted gross income. Now, you can always still make Roth 401k contributions. You can make those after tax, but the Roth IRA contributions might be limited to a point depending on how much money you're showing in a given year. So now, Corey had kind of gotten into a little bit earlier in this on that solo 401ks are meant for individually owned businesses. Now, this is not to say that if your business has employees, you can't have a 401k, but what it gets into is that you need to offer what's called a compliant or a safe harbor 401k plan. Now, that's not what we do here, but it's important to understand what exactly an employee is, because that definition is very important as to the type of plan that you can allow for. So let's say you are a general contractor, you only subcontract out all of your work, you have no regular rank and file employees. Well, you may have, let's say, 300 different subcontractors you work with, but you could still use a solo 401k. So it's important to understand exactly what is an employee. So employees that can be excluded from your plan. So if you want to have a solo 401k plan, these are the kind of people that can be excluded from it are individuals under the age of 21, a non-resident alien, or any type of union employee specifically covered under a collective bargaining agreement with regards to their retirement plans can be excluded. So certain type of union employees, non-resident aliens, and individuals under 21 can all be excluded from an employer-based plan. Now, we're not necessarily here to try to help people, keep people from being covered by employer-sponsored plans, but it's just important to understand what type of plan you need to establish if you have these types of people working for you. Now, what defines an employee actually did change a few years back with the passing of the Secure Act, which was the large portion of tax reform passed by the Trump administration, and that had language in it that partially redefined what a qualifying employee is. So those employees that so what is now considered an employee is not only just someone that works over 1,000 hours per year, it is someone who has or can't, let me get this straight, is not just someone who works over 1,000 hours per year, which was the previous metric to say, hey, this is an actual qualifying employee that is due any and all benefit packages that we offer. You should just be, if they worked over 1,000 hours per year, they have to be included in these types of plans. You need to have a safe harbor plan instead of a solo 401k. What was added in under the Secure Act is that you have to test the employee by saying, hey, have they worked 500 or more hours for 3 consecutive years over a 5-year testing period? So that's another thing to look at, is that if you have someone that really is part-time, maybe just a bookkeeper that comes in and does bookkeeping work for you, well, are they working over 500 hours? Have they worked that over that testing period? So you really need to look at that, because if you do set up the wrong type of 401k plan, you might have to go back and do retroactive contributions and also pay penalties to the Department of Labor and the IRS if you did not properly set up the plan to begin with. So understanding what actually constitutes an employee is very important in this context. So to get into a few more of the rules that we have with solo 401ks, because everyone loves rules, especially the IRS and the Department of Labor. So we're here to make sure that you understand, some of the different things that go along with this, and make sure that, you don't necessarily run afoul of some of the easy stuff that's out there to avoid. So prohibited investments just like with IRAs, you can't buy anything that's collectible, so no artwork, no rare bottles of wine, stamps, Pokemon cards. I know everyone's bummed about that last one. Some coins are allowed if the value is based on the actual metal content. So you can buy precious metals with a 401k or an IRA, and they can be in minted coin format. They just have to not be necessarily traded on anything other than just the Boolean content value. If you have any other specific questions with regards to what is a prohibited transaction, feel free to give us a call, or publication 4975 of the Internal Revenue Code covers it in painfully long detail, and then also covers the disqualified individuals from the aspect of whom you can and cannot deal with. One important aspect to remember, though, is that unlike with an IRA, if you are deemed to have committed a prohibited transaction with a solo 401k, it does not blow the plan up like it does with an IRA. It is a 10% penalty of the value of that prohibited transaction per year until corrected. So while it's not something you necessarily want to do, especially if you're talking about, let's say, a $100,000 transaction that has been in place for 10 years, that's, $100,000. You definitely want to make sure that you understand the rules of whom you can and can't deal with, and some of the other prohibitive transaction things that can definitely apply in certain situations with investing with these types of plans. And then another important one, especially when it comes to utilizing debt financing, is that solo 401ks are exempted from unrelated debt finance income tax on the purchase of new real estate. Now, this gets confused a lot of the time with people saying, oh, 401ks are exempt from UBIT. They certainly are not exempt from UBIT. UDFI is a subsection of UBIT. It's kind of one of the rectangle is a square, but a square is not a rectangle kind of scenarios you're looking at it. UBIT applies to business income specifically, not necessarily investment income. Now, if you were to, let's say, buy a laundromat with a solo 401k, you might certainly be subjected to UBIT. Or if you were to finance the purchase of, let's say, a large a large tract of commercial equipment that you were going to sell with a loan, then UBIT would apply there as well. The only type of exemption from the UBIT subcode, which is the unrelated debt finance income tax, is that if you are using non-recourse debt to buy real estate, that is the only exemption from it. So just understand that it's not kind of a blanket statement like you might see out there if you're doing some research. 401ks are not inherently exempt from UBIT. They are exempt from UDFI tax, specifically on the purchase of newly acquired real estate for that plan. So again, that is definitely more of a niche when it comes to this kind of stuff. If you have any questions, feel free to reach out. We can certainly dig much deeper into detail on what some of those things mean and how they actually would apply to you as the taxpayer and the owner of the plan. To kind of illustrate who some of the disqualified persons are, just to kind of put it up there in picture format, it's basically if you look at your family tree, you draw a line directly up and down. You cannot directly buy or sell to any one of these people. You can partner with them. These people can be included in the plan if they work for the business in some capacities. Others they might have to be equitable owners. So depending on what you do with your self-employed business and who's included in those business activities, you might actually be able to include some of these people in the plan, but just understand you can't necessarily buy or sell anything directly to them. Just to circle back for the UDFI, just remember that it's for only purchasing of new real estate. The acquisition of anything other than real estate with debt will incur a UBIT liability underneath of a solo 401k plan as well. Now, lastly, we want to kind of get into the different ways you can administer a solo 401k. There's people that like to do things all themselves. They like to use what people like to call checkbook control in order to administer these types of plans. We certainly do allow for that. We have a do your own model and we have a more full service model. And you can also utilize solo 401ks with things like LLCs underneath of them in order to do that. So if you wanted to have a do your own plan, essentially what this would work at in the context for John here is that John would open up a bank account in the name of the 401k plan as the trustee. He would simply just be renting the 401k plan document from us. He would make all the investments, he receives all the income, pays any expenses, and then makes any contributions directly back to that bank account. Really no involvement from Advanta at that point. He's just engaging us for the rental of the plan documents and then taking care of everything else as far as plan reporting goes with that do your own checkbook control type model. Now, this is attractive for a lot of people just for the amount of cost savings there is. It's a very cheap and streamlined way of doing things, but it's not necessarily for everyone. John has to file tax return forms. He has to sign investment documents, calculate contributions, and has to make sure all the assets are properly titled within the name of the plan. Now, if you want to do a plan where John has a little bit more third-party record keeping, in this case, Advanta would act as the bank as opposed to John having to go out and find his own. We would record keep any and all of the contributions to the plan. We would also record keep the assets and any expenses that are being paid out. So while this definitely is a little bit more of an expense that you're going to have to bear with regard to the plan, it definitely takes a lot of the burden off you as the plan trustee and the business owner for that matter, just to be able to have that additional level of support with that. But understand that depending on which way you want to go, there is an option for you, and we can certainly make that a workable situation for you. So again, looking at these things side by side, in both scenarios, the assets are held by the name of the plan. John Smith is trustee of the ABC 401k. The trustee still signs everything. DYO plans have trust accounts at a local bank that allow for you to just walk in, get a cashier's check if you need to. You don't necessarily have to coordinate everything through Advanta, but unfortunately, you do have to understand that all of the record keeping and anything else that is the duty of the plan or the plan administrator is all taken care of by the trustee. Advanta is strictly not involved in any of those types of transactions. So you just have to keep in mind that you have to be comfortable with performing some of those actions for the plan.
Just to follow up on what Alex was just talking about in this slide specifically, we do have a few different plan options for our solo 401k clients. Alex specifically referenced the do your own plan if you're the type of individual that likes a lot of direct control and access. And also that plan offers a very cost efficient expense from the administrator side of things. You're basically just paying to lease our 401k plan document with our do your own plan, and then you're handling everything else directly at your own capacity and in control. The other options that we have a standard 401k record keeping plan. This is more so the option that we've had for a number of years, and everything that we have here with the standard 401k record keeping plan, if you've already been an existing client of ours, it's pretty much the model that we've been using. But in 2022, we are working on rolling out this additional enhanced record keeping plan option where we are going to do a little bit more of the hands-on nature and roles for the 401k plan. So I have this chart up here specifically just to break down for everyone what each type of plan offers as far as responsibility for yourself as the 401k plan holder, and then Advanta as the custodian administrator. And it's obvious to also assume the do your own plan is going to be the most cost efficient in that capacity. The standard 401k record keeping plan, there is some expenses because of additional responsibilities taken on by Advanta as the administrator. And the enhanced record keeping plan would be likely the most costly, but that is in turn saying that Advanta is doing significant additional reporting and documentation for your 401k. Each of these options do have the ability to hold that checkbook control that Alex had referenced, with the do your own plan basically being a direct checkbook control. And then the standard 401k or enhanced 401k would be a strategy where you would establish an LLC and fund the money from the 401k account and the funds that you move to Advanta specifically into that LLC entity at your discretion. If you're interested in getting started with an account, it's very simple and easy from our side of things. Just reach out to Alex or I to receive an account application. It takes about 15 minutes to execute that application, whether you do it digitally by way of a DocuSign link that we send you, or just by completing a PDF that we can send you as well. We're happy to help you through that application. So if you want to have a phone call and walk through it with us, just feel free to reach out and schedule that. Funding your account, as I went over early in the webinar, is very easy. It can either be done via a transfer or a rollover. In any event, those are not taxable events. The transfer doesn't even have taxable reporting. The rollover, the taxable nature of it cancels out when you do put the money into the qualified plan that you're rolling out of into on Advanta's end. And then once that account is funded, whether it's the DYO plan or either of the other models that we offer, you can start your investing. Typically, an investor can get their account opened, funded, and their investment started within about 2 weeks' time, with an estimate of, conservative timeline for moving the money from your previous custodian over to the self-direct account at Advanta. Alex, I think that wraps up the real content here. It does not look like we've received any additional questions. So I'm just, oh yeah, sorry, the pitch, promote, prosper here. If you're interested in networking with us or with our network of investment providers and clients, we do have a bi-weekly networking forum that we host every other Friday. I just hosted it last Friday, and leading into the holidays, I don't know that we will have one through the remainder of this year, but keep a lookout or check on our events tab on our website. This is an open networking format where each person that signs on to this call gets a chance to say who they are, where they're located, what types of deals they're looking for or that they have to offer. And then from there, you can network and maybe work on some deals with some of those participants in that networking forum. Again, as I referenced at the top of the call in our disclaimer, we are not providing any specific endorsement or cosign of any deals you may hear of. So it's completely your discretion and educational purposes only. If you want to make any of those investments, do your own due diligence, consult your own CPAs or tax preparers. I'm going to go ahead and switch over to our contact info. If anyone still wants to write down mine or Alex's contact info to reach out to us directly. And I did see one final question pop up. Alex, if you want me to read that out, would you like to answer it?
I got it popped up right here. So it says, if my self-directed IRA is funding a flip right now with another company, can it be transferred, or do I need to wait till the flip sells and the funds are distributed? It is really your personal preference, depending on where you are in that transaction process. As much as I would love to put on my salesman hat and really say, do it right now, it might certainly be easier to complete the flip if you've already purchased it and then transfer over cash. If there's a particular issue you're trying to work around, or just a big just there's something that's really kind of driving you to get out of that current situation, it is not something you have to wait for. We can certainly transfer everything over and do it. Just keep in mind that if you are transferring property, there is a change in title via a quitclaim deed that has to occur, so that may or may not kind of throw a wrench into the closing. Any title agent can probably just record record several deeds at the same time to accomplish that. But just keep in mind that it certainly is possible, but would it necessarily be the easiest thing to do? Probably not. And depending on where you are in the process of actually selling it, again, might cause some additional things to pop up. So Susan, if you have any questions, feel free to reach out to myself or Corey. We both would be happy to help you out with the kind of digging farther into that if you can provide some additional details. But I think that is it. Corey, you got anything else that you want to add on?
Nope, that is all. Again, if you have any further questions, feel free to reach out to Alex or I. If you are interested in any of the similarly aligned topics that we've covered today, feel free to check out our YouTube page. There are tons of recorded webinars on similar topics like we've referenced. I believe the Mega Roth contribution, there's a webinar solely dedicated to that. Real estate investing, any other type of investing that you could want to do with a self-direct account, we've probably covered it, or if we haven't yet, let us know and we'll be happy to put out some content in that capacity in the near future.
All right, thanks, Corey.
All right, thank you, Alex.